Good afternoon, everybody. This is Katie calling in from Premier. Thank you very much all for you taking time out of your day to join us. We are super excited to be giving you information on the latest hybrid product that we have. Today we have Melanie Hertz. She is head of brokerage sales, and she's going to review the new Thrivent CareForward product. As we all know, the hybrids are a constant conversation that we have here. And to have something else to add to our portfolio, we are super excited. So with that, Melanie, you ready to take it away?
Absolutely. Well, thank you. Thank you. Very excited to talk to you about our brand new long-term care solution that's going to sit right alongside our traditional solution. So without further ado, please note that we created this presentation to educate you. It's very broad in scope, does not consider your client's personal financial situation. It's going to be unique to each person. So, you should keep that information in mind. And advice in this presentation might not be suitable for all situations. Whew. Now that we got that disclaimer out of the way, I want to take just a quick second and just level set on the why, right? Why we're all here. Personally, I've been dedicated to the long-term care arena for 19 years. We all know that the very, very best retirement income strategy can very quickly unravel if that strategy does not include a plan for extended care. So, we want to focus on the conversation as far as, impacting the people that they love, understanding that there's a chance that they might need care, and, discussing the need for the plan. Most of you, I think, on this call probably have a pretty good handle on how to get into that conversation, but since it is a long-term care presentation that we're doing today, this is the foundation for overall accumulation and distribution planning. Everyone deserves a conversation. So when you think about the CareForward product, we do know that it is a live, die, or quit proposition. I would say as a follow-up for today, we'll have a side-by-side comparison on like the benefits and such compared to like the Lincoln MoneyGuard type of solution, or the One America solution. Nationwide has a Care Matters 2 solution out. Securian has a product out. This is going to be in that same type of arena where you can live and have a large long-term care pool. If I was thinking about making, in my mind, the live bucket would be huge, right? The graphic for live, the reason you're buying this is for when you trigger your long-term care claim. So that graphic would be huge. But of course, there's a death benefit there. If your client is concerned about use it or lose it, you have the death benefit there. It's so cool how you can, with our solution, how you can change up the weight on the death benefit. We'll get into that here in a minute. But the death benefit is certainly there. And of course, if something changes, you can cash out. I don't personally put a lot of stock into the quit proposition, just because it means that when you surrender the policy, when you quit on the policy, it's going to take away that long-term care benefit, the reason that you put this in place, right? And we know the lapse ratio on these is super, super low. As a client ages, they're going to need it more than ever, right? So quitting it isn't really on the table as far as I'm concerned. But hey, it's on here in case circumstances change, right? So as far as this solution goes, it has the dual features. It has the cash value. It gives you full flexibility as far as the where and the how. Remember that when we put these solutions together, it's never meant to dictate where you receive care or how you receive it. It's only there to fund it and give your clients peace of mind, help protect the estate, whatever it is that they're trying to do as they're achieving their goals. The premium stability. Now, you probably already know this, that on the traditional side of the house, the Thrivent branded solutions have never taken a rate increase. I didn't go into it today, but we do have A++ rating with AM Best, a Comdex rate of 100. We are a fraternal, which I will touch on here in a little bit. But really, the strength of the solution is so important. With CareForward, the benefits are guaranteed, as are the premiums. And then we have our elimination period. So for CareForward, you have a 0-day elim for your CareForward solution, which is really, really nice. If you get into a facility, it is a 90, which we'll talk about here in just a minute or two. Come on. Before we do, though, let's talk about the structure on these policies. So every CareForward solution has 4 components. So even though it's a long-term care solution, it's on a whole life chassis. So you don't have to lead with how much the death benefit is, but it is important to know that there has to be a death benefit on this solution. That death benefit has to be somewhere between $50,000 and $500,000. As far as the true leverage for your long-term care pool, you can leverage, you can take that death benefit to get to your LTC pool. You can take that death benefit times 1, times 2, or times 3. So if you can imagine, like, starting out with a $100,000 death benefit, if you take it times 2, your long-term care pool would start out at $200,000. If you start out with $100,000 death benefit and you go 3 times the benefit multiplier, it's going to be $300,000 starting out. And then as far as like the what I'm going to call the meat and potatoes of this policy, you want to know how much that policy is going to pay out each month, right? And this is probably one of the coolest parts of this solution. You can that percentage payout on from the death benefit, it can be accelerated by 3%, 4%, or 5%. Now, when you take it times, or when you accelerate your 100,000 by 5%, that's going to give you the most robust payout. What I would call like a short fat, right? If you do the math on this, which when I first started looking at this, it took me a minute to wrap my brain around it. 5% acceleration on 100,000, it's going to get you 20 months. A 4% acceleration on the death benefit is going to get you 25 months. And then like a 3% acceleration would be 33 months. So if you can envision, the longer the duration, the lower your monthly payout is going to be. So when we talk about like a sweet spot, I think you'll find for a lot of folks that are long-term care heavy, meaning they're buying this for a meaningful long-term care benefit, going with like a 5% acceleration is going to make perfect sense for folks. And then, the leverage, you're probably not going to leverage the 1% very much, or 1 times multiplier, because in this case, a 1 times multiplier, if you have that $100,000 death benefit, there's really not much leverage there at all. All you're doing is getting $100,000 if you take it times the 1 times, right? It'd be 100,000, and then you have to choose your how much you're going to get it paid out per month, but it's not the greatest leverage. I'll pull up the software here in just a minute to help illustrate that. So like a 3 times multiplier looks phenomenal with a 5% acceleration on that death benefit. But that's not for everyone, and we'll show you. The other thing that I think is quite impressive with our solution is the inflation. You know, with our solution, and I know I'm getting ahead of myself here because I tend to do that, we go all the way down to age 18. That's a differentiator, right? All the way up to age 75. Well, for a lot of this market, it's going to make great sense to have some kind of an inflation option on that solution to help keep up with time, especially when the market is soft, right? If you can show your client that the rates are guaranteed and the growth on the policy is it's going to grow. This isn't a guesstimate. It's going to grow by 5% or 3% or 3% with a 20-year cap on it. Or, you know, there are going to be certain demographics where it might not make sense to put an inflation option on there, just depending on what their needs are going to be. So, as far as a quick overview of this solution, I would tell you that as far as the monthly maximum payout, right? People want to know how much it's going to pay out and how long it's going to pay. So we already talked about the issue ages being all the way down to age 18 up to age 75. With the different percentage payouts and the face amount, bottom line is going to be a minimum monthly benefit of $1,500, maximum monthly benefit of $15,000. And really everything in between. There's just a couple of outliers. If you're in South Dakota or Vermont or Wisconsin, those numbers might just be just a hair bit different. The software is not going to let you fail. But so it's $1,500 per month all the way up to $15,000 as far as your monthly benefit goes. We already talked about the percentage payout and the multiplier. We talked about the face amount. This is exciting. So with our payment options, you can certainly do a single pay, but we also have a 10 pay, a 20 pay, and a pay to 95 available. We're seeing about just over 20% of our business coming in on a single pay right now. A large chunk of our business is coming in on a 20 pay. And it looks really, really nice on a 20 pay. It looks phenomenal on a pay to 95 as well. But I mean, obviously, it's going to depend on what your clients' needs are. Yes, we can absolutely 1035 into this solution. Those are just a couple of thoughts on it. We talked about the 0-day elimination period for home care into the solution. We know that you can, the rates are going to be guaranteed. The benefits are going to be guaranteed, and you can surrender the solution. It's going to be, you know, on a schedule, right? There's depending on exactly how far you're in, what kind of payment mode, there's just different factors that'll help determine what the cash surrender value is going to be. It is a tab 7702B solution. So your death benefit is going to be tax-free. Your LTC payments when you trigger a claim it's a tax qualified solution, so not taxable unless, of course, it's higher than the per diem. And then, of course, just remember that even though it's a 7702B rider on the whole life, the CareForward solution does not meet today's definition for partnership in your state. This is not like a shared care type of contract. It's going to be a solution for him, a solution for her. This solution is not expected to pay out dividends. All right, so let's talk through a case study here real quick. We've got our hypothetical client, age 50. Now, what they're looking for in this scenario is a $5,000 monthly long-term care benefit. They like the idea of the linked benefit solution where you have both a death benefit if you don't need it and a robust long-term care benefit if you do need it. In this situation, what we tried to do is we're just trying to show that $100,000 death benefit. We took the long-term care multiplier of 3 times the death benefit to get us to the $300,000. Then we accelerated the death benefit by 5% to get to the $5,000 per month, and tacked on an inflation guard of 3% compound for a 50-year-old. So in this situation, they buy at age 50, and it starts out at a $100,000 death benefit, $300,000 long-term care benefit, paying out $5,000 a month. At age 80, it's going to have grown to $706,000, a monthly benefit of $11,700. You still have that death benefit of $100,000, and you can still cash out. I think I mentioned this is on a whole life contract, so that's why that death benefit remains the same. To be very, very transparent with y'all, remember that the death benefit is the first thing to go. And actually here I am jumping ahead of myself. Just to be very, very clear, on this slide, we're showing that same structure, right? Age 50, $5,000 a month. If you've got a $100,000 death benefit and the client went on claim for a short period of time, the policy paid out $60,000, then the balance on this solution would be $40,000 paid out to a beneficiary. If, of course, they would live, they've still got, well, in this case, we did not have the inflation option on here, I see. So it was a $300,000 solution that paid out $60,000. So they'd have $240,000 left in their long-term care pool if we don't have an inflation guard on that. All right. So when you think about all of the things between the CareForward and the traditional solution, you still trigger the claim the same way. 2 of the 6 ADLs or cognitive impairment expected to last 90 days or more. It's still a comprehensive solution. It's going to cover you in a home health care, assisted living, nursing home, adult daycare, as well as in hospice. We've got the ancillary benefits built into the solution. I will call out, international care on this solution is considered an ancillary benefit. Our solution is maybe a little bit light when it comes to the international care. I respect you all enough to be transparent with you on that. How it's going to work with international care is it's going to pay out 2 times the monthly maximum benefit, basically to get you back into the States. And that's for the life of the contract. So I just want to be very, very transparent with you there. That's how that international care benefit works. It is a reimbursement model. The other thing that always comes up, what's the residual death benefit on this solution? And I will tell you that we don't have a residual death benefit on our solution. This is going to be a long-term care heavy solution. Granted, you can still go down to a 4% or even a 3% acceleration to get a little bit higher death benefit if that's what you choose to do. But we did not include a residual death benefit on it. We feel like if people are buying this solution, they're buying it for long-term care purposes, and we went pretty heavy on the long-term care benefits. So if you like long-term care, your client's needs or long-term care, this is going to look phenomenal for you. Couples discount is really, really cool. So let's say that, on the traditional side of the house, if both of them apply, they get a full spousal discount. But if only one applies with traditional, it's only a 5% discount for the person who applies. With CareForward, it is a full spousal discount regardless of who applies. But wait, there's more. If you have, for example, the wife wants to take a traditional solution and the husband wants to take a CareForward solution, they're both going to get a full couples discount for having a long-term care solution together, even though it's not the exact same solution, but it's under the same family. So we have a way to administer that. That's really fun that we have that. There's nobody else out there that can give you that, so we're pretty excited about it. Kind of already told you about all the other benefits on this, so I'm gonna keep flying. Underwriting. Of course, we need to understand that it's not our checkbooks that buy these solutions; it is our health. The underwriting guide has been merged into one, so you can do both traditional and CareForward in underwriting guide. You've got one pre-qual form. If you go to pre-qualify your client ahead of time, you'll fill out the form once, and you'll have the contact information on there. You'll work with a Premier, Katie, and the team at Premier to get these pre-qualified. But it's just one process, which is fantastic. That being said, it's not going to be a great experience for your client to apply for both CareForward and the traditional Thrivent solution at the same time. So CareForward is underwritten in-house here at Thrivent. The traditional solution is underwritten by our partner LTCG. I, of course, am getting ahead of myself again, but you need to know that it's two separate declaration of insurabilities. What's the declaration of insurability? Those are going to be things like height, weight, medications, basically the scope of the client's health. It's a separate process between CareForward and traditional. And quite frankly, if a client is eligible for accelerated underwriting, but they apply for both solutions at the same time, they're automatically going to get kicked out of accelerated underwriting with CareForward. Our system doesn't allow for accelerated underwriting if they're going through underwriting with the traditional solution while they're doing a CareForward app as well. What I would tell you as far as the rate classes go, so CareForward has 4 rate classes. A tobacco and a non-tobacco, but then also a non-tobacco class 1 and a tobacco class 1. If a person was rated on traditional, like a class 2, or previously declined by our traditional solution, I'm not going to say that they absolutely will not get it with CareForward, but it's going to be very tough. Generally speaking, they're not going to be eligible for CareForward if they were already declined on the traditional side or even rated up to a class 2 with our traditional solution. Now, that being said, if the reason for the decline or the rating to a class 2 no longer exists, or has improved, definitely let us run it up the flagpole, see exactly where it's going to come out. What I would tell you is I would not throw it at the wall and just see what sticks, because it probably isn't going to stick. As far as who qualifies for accelerated, it's going to be those younger age brackets. Remember, we can solve for an 18-year-old all the way up to 75. Accelerated is going to be through age 60. The face amount is a moot point because that's everyone. And with that declaration of insurability, so on the traditional application, it's optional. You can either fill it out with your client or the client can do it over a phone interview. With CareForward, after you've pre-qualified your client, right? Once they've taken an application, it's done either phone interview or the client can do it electronically, the electronic declaration of insurability. It's done online. You'll always want to pre-qual your client every time. If they fall into accelerated, but like something comes back in the claims database, prescription drug database, the MIB, maybe something alarming comes up in when they're getting their DOI, the declaration of insurability, giving you medication and details and so forth on their, it could easily kick it out of accelerated underwriting. All right, so I want to make sure you are clear on where you can 1035. So with CareForward, it's really going to be, and this is probably not new news to you, like for like. So like if this is like CareForward is a life insurance solution. So if you're doing permanent life and it's a full surrender, you can 1035 into CareForward. If it is a life insurance combo product, life insurance, you can 1035 into CareForward. Not term, not an annuity. And you can see where the traditional is going to fit in. That's where we come in here. All right. Let's see here. Just real fast. I'm gonna actually do something terrible and just skip over this. I want to get into the software and just show you very quickly hands-on. I might have had this sitting too long. Let's see if it's happy with me or not. I'm going to go into my software, which you'll all have a link as a follow-up for this today. You'll all have a link on how to get into the software for CareForward. And you'll get, Katie will be sending that out. I'm going to go in and choose to create a CareForward quote. So first off, thing I'm gonna call out. So it's the 16th of June today. I'm gonna say my client's birthday is 5/20 of 68, I suppose. See how it saves age on here because we're within a 3-day window for saving age, and it'll tell you right here. Due to the recent birthday, it has to be submitted within 30 days of the birthday. So keep that in mind. It's going to save age for you. You can override it too. If you know there is no way I'm going to have an application submitted by the 20th of June, then just change it to the next age bracket, right? The other thing with CareForward, it's a life insurance solution. Technically, somebody can own this solution other than the insured. So it's going to tell you right here that if your client is, or excuse me, the person who owns this solution is not the insured, you have to use the state for the person that owns the contract, which brings up a good question. Lots of people ask this. Well, where are you guys at? We're in every state except California, which only because it's not approved yet. And then we're not in New York, and we did not apply for a solution in New York. We didn't even file there. But we should be getting it. I'd love to tell you that we were to have an approval by the end of the year. We really don't know. So, all right. I'm going to keep cruising along here. Here's our rate classes. I'm going to choose a couples discount today. You can see your different payment modes. With this solution, you can only pay on an annual basis or a monthly basis. So just because this is what most people want to see, I'm going to just go in here. Remember, we were talking about the how much and the how long and the face amount, and maybe your eyes were starting to glaze over. Hopefully I haven't put you to sleep yet. I know I get a little windy sometimes. Let's put in a $5,000 monthly benefit. When I do that, it's going to the system is going to default to the sweet spot for most clients, right? That's going to be a 3 times multiplier, 5% payout. When I let it just do its thing, it's going to start me out with an annualized premium of $34.37. What I'm going to get for that $34.37 is a death benefit of $100,000, a long-term care benefit of $300,000. It shows me my duration of 60 months, 5 years. How I get to that is through this percentage payout and the multiplier. And I forgot, she's only 54. I probably want to put some kind of an inflation option on this, right? So let's take a look at, I don't know, let's try 3% compound for life. So it jumped the premium sum. Now it's $6,084. For that, I've got starting out a $300,000 long-term care benefit at $5,000 a month. And my benefit at age 80 is going to be $646,000, $10,784. What happens when I take this to a 3% compound with a 20-year cap? So right now I'm coming in at $6,084. If long-term care solutions were free, everyone would have it. Wow, I just dropped that benefit a little. Nobody's going to throw rocks at you if the policy is paying out $9,031 at age 80 per month. Still a nice pool of money, $541,000. Still have your death benefit of $100,000, and we just dropped the premium to $5,000. Now, there's other things that you can do on this. I could say, why don't we try a little bit lesser pool of money? There's no reason why we need to start out at $300,000. Watch what happens to the premiums and the benefits. So, it drops the premiums about $650. You still have that $9,000 benefit because you're accelerating it by 5%. And the bucket of money, the total bucket, went from 500 and some thousand to 361,000. Your duration with this combination goes to 40 months versus 60. Just because I want to make sure that you have a chance to wrap your brain around this, I'm going to take it to a 4% acceleration. Now watch your monthly benefit goes from, it starts out at, $5,000 because I chose to start it out at $5,000. So in this case, I guess we got to watch our face amount. See this? I'm going to go to 4% acceleration, and to maintain my $5,000 monthly payout, I have to give more of a death benefit to get to that. So my premiums are $52.66, and because I'm solving for a $5,000 monthly benefit. And in this case, I've got a duration of 50 months. Just to try to reiterate this a little, I'm going to take it to a 3%. My premium is going to go up to $6,500. Why? Because I'm solving for a $5,000 monthly benefit. To get to that $5,000 monthly benefit, when you're accelerating at a lesser amount, it takes more death benefit to get there. It's a longer, skinnier. See how it goes to 66 months versus 40 or something, 50. And you still have the same deal here as far as your benefit at age 80 because you're solving for the $5,000. where I got myself just slightly tangled up a little bit ago, I want to show you another way. If you go into the premium amount, and I'm going to take this to a monthly budget, I'm going to say, what is $250 per month going to buy me? And this is where you can have a lot of fun with the package. Right away, it's like I'm looking at this benefit and I'm saying, okay, for $250 per month, I can get $73,000 in a death benefit, $146 for long-term care. My monthly benefit is going to start out at $21.94. At age 80, it's going to be $39.62. Not bad. Can we do better? How about a 4% acceleration? Same budget, $250. Do you see how by taking it from a 3% acceleration to a 4%, now we're starting to make some benefit here. It's almost up to $5,000. I don't know if I can get myself into a 5% acceleration at this age, but I'm going to try. So I can, and when I do that, for that same $250, now I've got myself up to a $6,000 monthly benefit. It is 39 months, not bad, a little over a 3-year duration that this is going to pay out, but most importantly, getting $6,000 per month. I can try. If I take it to a 3 times multiplier, it's going to drop my monthly benefit back down a little bit because I have to pay for that pool of money somehow. So if you're comfortable with $5,200, that's fine. But if you're looking for something maybe a little shorter and fatter, you might have to take it to a 2 times multiplier to get to that little bit more meaningful benefit. And that's where you're going to lean on Katie and her team at Premier to just help you understand some of these sweet spots. If they need a heavier long-term care benefit, the 5% is probably going to make sense. Maybe going to a 2 or a 3 is going to look good, versus if they need a little bit heavier life insurance, you might have to back this down. Maybe even they're probably not going to need a heavier life insurance unless you're going with a little bit shorter benefit here. I'm going to solve for a monthly benefit again. You can kind of just see how that would stack up. I know I throw a lot at you today in kind of a short period of time, but what I'm trying to just reiterate is that there's a lot of different ways that you can position this. It's these moving parts that can kind of feel overwhelming that will also give you more options to get to better price points, more packaging options to truly fill the needs of your clients. We're about out of time. The last thing that I'm going to show you is our comparison tool. So this is a brand new thing with CareForward, and this is just a hypothetical. So when you get into the software link, you can go in, and in this case, I'm showing a traditional solution with 2 CareForward solutions. You could show all 3 CareForwards, all 3 traditional. It just depends on what your client is going for. On this one, all we tried to illustrate here is you can get into a traditional at $4,500 a month, 5-year duration, 3% compound. The premium is going to be $46.20. The benefit at age 80 is going to be $94.22. And then we have this really cool self-fund tool built in. You can get into a CareForward for about $1,000 a year more. So it's $46.20 versus $56. And with that, the benefit for long-term care is going to be the same, right? The benefit is you have a $90,000 death benefit to play with as well. The other thing, of course, is the 3% compound with a 20-year cap on it. Pretty cool. In this case, for about the same premium, a couple dollars more, $46.66, almost the same as a traditional. The difference is that the benefit is going to stop growing in 20 years because we put the cap on it. It's going to be 81.28 at age 80 versus 94.22. Your pool of money is going to cap out too, but still a nice benefit. The sky is the limit. You can do a single pay comparison, or a 10 pay, or you can show the different solutions like we did here. That is, in a nutshell, what we have for a presentation today. We certainly appreciate you thinking about CareForward and Thrivent's long-term care solutions. We have a couple of great tools that we will pass along to Katie here shortly, so that you can take a little bit closer look at the support materials, the comparison tool, and a few other items. I want to thank you, Katie, and everyone for letting us show you a little bit closer look under the hood of what this CareForward solution is going to be. Remember that we are fraternal. To be eligible for this solution, you do have to be a Christian or the spouse of a Christian. That membership question has not gone away. So we will have the eligibility on that is part of a follow-up for this as well.
Thank you so
Katie,
much.
anything else?
I really do appreciate it. I think this was great. It was a great overview. I'm sure there will be additional questions. We do have a question section. I have a couple questions that have been posted right now. And one was regarding eligibility on issue ages. What would be your issue ages?
Okay, so we go all the way down to age 18. So anyone between age 18 and age 75 could be eligible for this solution. So 18 to 75.
Perfect. Another question was regarding underwriting. So if they do a pre-qualification form, are they given a reference number? I know a lot of our carriers are doing that when we're doing any pre-quals, and we do get a reference number. So that was just a side question.
We used to do the reference number on all of them. And instead, what we just ask, if you phone in, they will give you a reference number. If you, and that is perfectly fine to do that, and you'll see that on the pre-qual, how to do that. If you don't phone in, just attach the pre-qual to the application.
Perfect. Well, I think you've handled all the questions. I'm sure there will be additional as people get in and start quoting and looking at it in a little more in-depth view. But until then, thank you everyone for attending. I really appreciate your time. And Melanie, as always, it was a pleasure, and I look forward to working with each and every one of you. We'll talk to you guys all soon. Have a great afternoon.
Thank you.